Markets have recently fallen because analysts are predicting a possible recession. And bear in mind, I only said a possible recession. What exactly are they referring to? Well, what's occurred is an inverted bond yield. Okay, now let me explain what that actually means. The curve on expected interest rates has inverted. So normally what you'd expect with government bonds is that over this side, let's say it's yield, and over this side, let's say that we have years or term. It could be as low as perhaps 3 months or 30 years. Normally, the longer that you give your money to the government, then the higher the interest rate. So you expect the curve something like that. Okay, what's happened at the moment is that bonds are showing, if this again is yield and this is term, they're actually showing that interest rates already relatively low are going to fall and then sharply increase. Okay, so is that an indicator? Well, actually, it's the most accurate indicator of a recession. Doesn't guarantee a recession, it just means that you have hundreds of thousands of analysts around the world. So my explanation on that is that imagine there's hundreds of thousands of people working for large banks and financial institutions. They're using computers, they're looking at the market, they're looking at trade going on around the world, and they're actually predicting that interest rates are going to have to fall because there is likely to be a recession. Okay? Doesn't mean it's accurate, it just happens to be one of the most accurate measures of a recession. Okay, if we look at this, then you'd say, okay, what do I do? Well, markets have already fallen, so actually, in order to, if you sell, that's probably, in my opinion, not a good idea. All right, reality is they will have fallen and you're probably too late to sell. So actually, what you do is you hold and you make sure that you're diversified on your investments. And the good news is that when we look at the curve, it says short-term recession, and then actually interest rates rising quite quickly. So the positive news is that if there is a short-term drop in world trade, and it could have been caused by lots of things. We've had trade wars with China and America. China figures recently don't look as good as they perhaps should be. America appears to be flat. German economy figures last week were atrocious. Looks like they're struggling. So what we're saying is that 3 of the biggest economies in the world are actually either flat or appear to be struggling. Okay, now there's good news in there in so much as governments these days know what to do. They can make sure they print more money. They can be reducing interest rates. They can do all sorts of things to stimulate the economies worldwide. And then what you see is that all of a sudden the economy starts to grow again. All right, I'm positive. I do think that we've got a short-term sell-off here, but I said short-term, and that means an opportunity to be invested into good stock, into good investments. I'd always say diversify your investments. Don't put your money into one asset class. Make sure that you're actually diversified and you've actually got a good financial advisor to sit down with you and advise you on how best to diversify your money. It's always better to be in the market rather than to be out of the market. Over the next 5-10 years, you'll make good returns and you'll be pleased that you stayed invested. If you come out of the market, very difficult to time going back in, almost impossible. In fact, I can't think of one successful investor that does it just by timing the market. If you look at all the top investors, they're people that look at finding good quality stock. They go for good quality companies. They diversify and they stay invested. That's the best advice that I can give you this morning. Hopefully this video was useful.